Be great. Good morning and welcome to a joint meeting of NYCERS and BERS. I would ask that anybody who's in the room on a computer just mute it so that there's no echo.
Oh.
Thank you. So with that, I'm going to turn it over to the Deputy Executive Director of NYCERS to call the roll.
Good morning. Mayor's Office, Chair.
Kevin Liu, present.
Controller's Office.
Allison Hirsch, present.
John Dorset, Designee for Controller Brad Lander, alternate, present.
Public Advocate's Office. Borough President, Manhattan. Borough President, Brooklyn. Borough President, Bronx.
Robert Maraglio, designee for Borough President Vanessa Gibson.
Borough President, Queens.
Alan Swisher for Queensborough President Donovan Richards.
Borough President, Staten Island.
Dan Master for Staten Island Borough President Vito Fasella.
International Brotherhood of Teamsters.
Julie Kobe and Ruben Torres via Zoom on behalf of President Gregory Floyd.
Transport Workers Union. District Council 37.
Alongside Ray Santander on behalf of Executive Director Henry Garrido.
We have a quorum.
Thank you, and we will note any trustees that join after we commence with the program. We'd also like to ask BERS to acknowledge any of the trustees and staff that are on.
Hi, this is Salil from BERS. I wanted to acknowledge Alice Ho, as well as alternate Russell Bateman Buckley. I believe I see Maisha Sapp in the room. The screen's kind of small. Also, wanted to acknowledge designees, both Alton Hirsch and John Dorsa. We don't have quorum, but we'll take these matters up at our next committee meeting.
Great, thank you very much. And with that, we're going to start with a public agenda that's pretty robust this morning. We have a quarterly report followed by a risk update, and then we have a couple of additional initiatives that we'll be discussing in public session. So with that, Steve, are you on?
Yes, I am, John. Can you hear me all right?
Yes, we can hear you great. Your slides are coming up on the screen, so we're going to turn it over to Steve Meyer to walk us through the quarterly report. And for those zooming in, this is a NYCERS meeting with BERS, with an invitation extended to the BERS trustees. So some of the slides may be NYCERS centric in the public session, but much of the information that can be gleaned from this also affects the Board of Ed retirement system. So I just wanted to make that caveat for those folks zooming in. So with that, Steve, the floor is yours.
Terrific, John. Thank you. And good morning, trustees. Apologies in advance for not being there in person and not being there via Zoom on camera. My technology has been challenging me this morning for the last hour and a half, so I do apologize, but we'll get, I'm wearing a collared shirt and a sweater vest anyway, although I'm here in Florida today. Before we get into the meat of the presentation, maybe just a reminder, as long-term investors, the following trends we believe will actually drive performance in your portfolio over the next decade. And those trends are as follows: decarbonization or climate change, which I think will be very impactful, shifting demographics and the impact on labor force dynamics, both here in Europe, in Japan, China, UK, so pretty much around the world, deglobalization and a focus on supply chain robustness following the pandemic. And that means onshoring, nearshoring, friendshoring, and that impact on bringing things closer to home here and abroad. Also, sovereign debt sustainability. The level of sovereign debt has increased dramatically over the last 10 years following the global financial crisis, and certainly the pandemic, and will have a significant impact, I believe, on the cost of capital. which will be a positive yield contribution to your portfolios, which I'll talk a little bit more about in a moment. Also, altered geopolitical conditions and the impact on things such as global trade, defense spending, and trading alliances front and center. And lastly, transformational technological developments. Here we're talking about artificial intelligence, which I do think will have a profound impact on the economy and your investment portfolios over the next 10 years. We look at these trends to get a sense for how they will impact the building blocks of our economic performance and investment returns. And those building blocks very simply are economic growth, inflation, productivity, public spending, and private investment. And again, that's both here and abroad. Kate, if you go to the first slide, please, just take a look at U.S. and global inflation. The clear trend here is and abroad is for lower levels of inflation. The disinflationary trend that the central banks around the world have been focused on is well intact, and we are making good progress there, albeit it may have slowed a little bit here in the States recently. On the next slide, you can see a chart, a 10-year chart of U.S. inflation, and you get a sense for, again, the dramatic spike in inflation following the pandemic and supply chain disruptions. Again, we had over 9% inflation in the mid part of 2022. That's come down nicely to around 3% as measured by CPI in white. And the Fed's preferred measure of inflation is the core PCE deflator. It's there in yellow, closer to 2.8%. And the Fed will get a new reading on that key indicator on March 29th, which is a week from this Friday. On the next slide, just again, a representation of inflation around the world. And you can see that inflation, again, that spike and that recovery down towards that 0 to 2% bound with a focus on the 2% targets that most central banks have across this 20-year chart. On the next slide, just a reminder that we've had a very strong U.S. labor market supporting a resilient U.S. economy. And there are legitimate questions out there as to whether the Fed will achieve the soft landing that they hope to achieve, meaning a slowdown in the economy that doesn't necessarily push unemployment higher, but maintains inflation at their target levels of approximately 2%. On the next slide, just a look at unemployment. Again, here we can see that unemployment more recently was at 3.9% in white at the bottom, and the labor force participation rate measured in yellow up top. You can still see it's about 1 percentage point below where it was pre-pandemic. And I think that has to do a lot with folks that perhaps retired early during the pandemic and not re-entered the labor force. On the next slide, a look at economic growth here and abroad is held up very well, surprising many economists, particularly given the dramatic rise in official interest rates in 2022 or 2023. At this point of the slide presentation, I would make the remark with the exception of Japan. However, Japan did raise rates yesterday. For the first time since 2016, they actually had negative rates of 0 to 10 basis points, or actually a target level of official rates of negative 10 basis points. They've actually changed their policy again as of yesterday. The first rate hike, believe it or not, since 2007, which is pre-pandemic, almost 17 or 18 years. But again, they're off that negative rate experiment, again, moving now to a range of 0 to 10 basis points. They've also mentioned yesterday in their official statement that although they continue to buy and position in Japanese government bonds or JGBs, they're no longer buying stocks and bonds, REITs and corporate bonds. So again, some normalization in one of the stronger and more important economies in the world. On the next slide, just to look at economic growth, again, here and abroad, those are the 5 primary markets that people tend to focus on. On the far right-hand side, what I look at is the two economies that are really positive in terms of China, that's targeting what they refer to as an ambitious 5% GDP growth rate in 2024, in the U.S. in red, which is slightly below that. China, however, has had some real headwinds recently. They're suffering from a property market slump. They've experienced deflation now for a couple quarters. They have demographic challenges, as many other economies around the world have, and in particular an aging workforce and low birth rates. They have an over-leveraged shadow banking system, and they've actually seen and are experiencing declining exports as the West again, focuses on those more robust supply chains by onshoring and moving some of their manufacturing away from China. On the next slide, regarding Fed official interest rates, at one point in the latter part of last year, early part of this year, the market was actually pricing in almost fully seven interest rate cuts of 25 basis points in 2024 versus the Fed's estimate of just 3. And questions remain as to really, will the Fed actually achieve the 3 rate cuts given, again, the resiliency of the economy and the stubbornness of inflation stuck around, slightly around 3%, maybe a little less in core PCE. We'll get more insight into that today. Today is actually the March 20 Fed meeting date, and we'll get the results of the outcome of that meeting at 2 p.m. today. And the quarterly updates are typically more important because every 3 months they revise what's referred to as their supplemental economic projections or their dot plots. So the market is anticipating perhaps some changes there, and we'll wait with bated breath to see whether Powell does make adjustments in terms of his expectations for rate cuts this year. And the risk is that I wouldn't say the risk is a change, potentially is instead of 3 rate cuts, they're talking more along the lines of 2, again, given the resilience of the U.S. economy and the stubbornness of inflation. One other note on this page, I guess, is regarding FOMC meeting calendar for 2024. It is an election year. The Fed, it's unofficial, but they typically try not to change rates so close to an election. So we'll be watching for any impact on that. So today's an FOMC meeting date. We have a meeting on May 1st, then June 12th, again, which is about a 65 to 70% chance of a rate cut is being priced into market then. You've got a meeting at the end of July and July 31st, but then you get into September 18th, and that's pretty close to the election. So there's probably a reluctancy on the part of the Fed to make any changes to official interest rate policy that may influence the outcome of the election. On the next slide, again, just a look at where we've been. Again, I would have said yesterday the top 3 markets, Fed funds, Bank of England, and ECB deposit rates, all pretty much unchanged since the middle part of 2023. The Bank of Japan, again, was stubbornly stuck at a negative 10 basis points official rates, and that all changed yesterday. It's also important to note that Japan has actually seen some other interesting hurdles achieved already in 2024. The Japanese stock market has actually hit its all-time high for the first time since 1989. This is another reminder why we diversify away from just one asset class or one asset sector, even though those sectors may typically have high returns. It took 34 years for the Japanese Nikkei to get back to its high water mark, again, achieved in 1989, so significant there. On the next slide, just a consideration of U.S. credit spreads. We've seen high yield, investment grade, and private market credit spreads come in quite substantially, partially because of the market pricing and a soft landing, potentially lower risks associated with defaults, but also relatively high relatively high absolute yields. So as base rates have moved higher in treasuries and base rates have moved higher on official rates, you've seen that the yields achievable on high yield and investment grade and even private credit in absolute terms are quite attractive, well north of 7%, 8%, and in the case of private credit, 10 to 12%. And if there's equity kickers associated with warrants in some of those facilities, 12 to 14%. So again, base rates are higher, notwithstanding the fact that credit spreads are tight. U.S. Treasury 10-year yields, just a reminder, in 2010, it started the year at a yield of 3.89. It ended the year at the same level, 3.89%, although it had quite a dramatic level of volatility. It's trading as low in yield as 3.30%, all the way up to 5%. And as of this morning, I'm looking on the screen now, it's about 428, up about 40 basis points from where it started the year. Some of the uplift, I'd say, in base rates or U.S. Treasury rates are due, obviously, to the fact that we've had a resilient economy, perhaps shifting expectations around Fed policy. And again, I mentioned earlier the potential for a reduction in the expected rate cuts this year, and also the stubbornness of inflation. One other thing that I think is factoring in, I mentioned sovereign debt levels earlier. The U.S. Treasury continues to issue an enormous amount of Treasury obligations associated with 1.6 to 1.7 trillion dollar deficits and just a rolling over of their debt. So that's something to certainly watch. It is actually positive for the portfolios. For your fund will actually benefit from the higher base rates because it provides a little more of a contribution from your fixed income allocations, both public and private. On the next slide, a look at U.S. Treasury yields. Again, on the far left-hand side, you can see what's become common for my presentations over the last year and a half, but somewhat uncommon in that we have an inverted yield curve where short rates are higher than long rates. This is now the longest yield curve inversion on record. Certainly not the deepest. The deepest occurred in 1980-81, where it was a negative 190 basis points in inversion. Today it stands at just precisely 40 basis points right now, with the two-year treasuries 40 basis points above, again, the 4.28 offered for 10-year treasury yields. Let's skip the next slide, Kate, if you wouldn't mind, and just go to credit spreads on slide 14. I mentioned earlier the credit spreads have come in quite dramatically. This is actually a 10-year chart that looks at credit spreads in high yield in yellow or orange, and investment-grade credit spreads in white. And you can see that they're both right now substantially below where their average 10-year yield spreads have been. So again, credit spreads tightening. I think it's more of a story about a stretch for absolute yield, and that these instruments are much more attractive today than they were, say, over the last decade. And that's due to the fact that base rates are substantially higher. On the next slide, U.S. base rates, as I said, are higher than they were pre-pandemic. Again, that's a stretch for yield, probably associated with higher yields. Again, good for your portfolio. And stock market indices are actually near or at record highs. It's actually important to note that the S&P 500 actually hit an all-time high yesterday. And another positive development there is a broadening of the rally in stock prices. 10 out of the 11 sectors of the S&P 500 all were up on the day yesterday. On the next slide, a look at your benchmark returns for the fourth quarter of 2023 and beyond. It's nice to see a lot of green on the screen. The fourth quarter public market benchmarks all performed strongly. And you can see at the top of the chart there, in the fourth quarter alone, the Russell 3000 actually increased by 12.1%. So a good outcome here and abroad. You can see the developed market ex-US equities in the middle part of the page up 10.5%. Emerging markets even returned 7.9%, notwithstanding the challenges in China. And then fixed income and a nice rebound from a more challenging 2022. On the next slide, a look at developed equity markets around the world. Most developed market stock indices are higher year to date in local currency terms. Year to date, as of 3/13, the Russell 3000 was up fully 7%, which is on top of the 26% return experienced in 2023. And again, I mentioned earlier that Japan's Nikkei has had its hit its high water mark again for the first time. Year to date, you can see towards the lower portion of the chart, the Nikkei is actually up in local currency terms, meaning in terms of yen, 15.63% again for year to date through the 13th of March. On the next slide, bond prices. So bond prices are typically lower across the board. Yields are higher associated with those declining bond prices. You can see the United States up top. The change in yield year to date here is 30 basis points. It's actually now about 40 basis points given where things are pricing today. Again, bonds are lower in price and higher in yield. And that's almost the case across sovereign 10-year bonds around the world. There are two notable exceptions. The first one I'll point to is Italy. Italy's economy is actually outperforming Germany's, which caused their 10-year sovereign yields actually to decline relative to Germany. So again, there's a positive increase in prices there and a decline in yields. The other noteworthy sovereign bond market to look at is China at the bottom of the page. And you can see year to date, again, through the 12th of March, China's 10-year sovereign debt has come in 22 basis points in yield, again, associated with a sluggish economy. Maybe skip ahead 2 slides to the Callan periodic table of investment returns. This is one of my very favorite charts. I like to produce this on an annual basis and review it as a reminder of the need for diversification and the benefits of diversification. It really tells me you never know which markets are going to outperform. This is why we take an approach to diversified portfolios that, again, are expected to perform in all markets. They're considered all-weather portfolios. Again, just a reminder, if you look up where we were last year, large cap equity returned over 26%, developed market ex-US, again, 2023 working down 17, almost 18%, small caps almost 17%, high yield 13%, and on down. There's just so much information associated on this page. If you look at where cash equivalent yields were, very, very low through most of the 2010s, associated with very, very low interest rate policy following the global financial crisis. And if you look pre-GFC, you can see on the upper left-hand side, 2004, 5, 6, and 7. The story really there was real estate and non-U.S. equities outperforming other asset classes. So again, speaks to the need for diversification and owning what may not be in favor today. On the next slide, in recent news, a resilient U.S. economy has got some very prominent economists and market prognosticators questioning when and if the Fed will cut rates. You can see Apollo, we had Thurston Slock, actually a guest speaker on our Friday Thought Leadership Speaker Series a couple of weeks ago. He subsequently came out at the beginning of March with a proclamation that the Fed will not cut rates in 2024. You also had another individual as prominent as the former U.S. Treasury Secretary Larry Summers come out and say that the Fed's next rate move may not necessarily be a cut the market expects, and there's a non-zero probability, which he attached 15% potential for the next move to be a hike. And lastly, on rates, more recently, Minneapolis Fed Chair Neil Kaskari has estimated that he thinks there's only 1 to 2 25 basis point rate cuts coming in 2024. On the next slide, a look at sovereign indebtedness, and I talked about this earlier in terms of putting upward pressure on base rates. Again, positive for portfolios, not necessarily positive for the governments that are now going to be struggling under these higher debt burdens. This slide actually shows the change in the general government debt levels of these economies and countries, not necessarily public debt, but general debt. You can see there's one exception on the far left-hand side. Germany actually has less general government debt than it did in 2010, again, which is positive for that country. But you can see all others have increased their level of debt quite substantially, and we worry about crowding out and, again, upward pressure on rates. And I'll talk a little bit more about that in a moment. Okay, maybe skip the next 2 slides. And actually, let me get to that. So this is actually an interesting slide on slide 24. It actually shows the trend in declining foreign ownership of U.S. government bonds since 2015. And foreign buyers were typically the Bank of Japan, Bank of China, again, associated with trade imbalances and the need to actually maintain holdings in dollars to not affect their local currencies in a dramatic and negative way. But as foreign owners are currently buying less and less of our government obligations, what occurs is there's more buying on the part of domestic participants that are typically more yield sensitive. And again, that's why I believe that you're going to see upward pressure on base rates relative to where they would have been otherwise. Again, positive for your portfolio, positive providing yield and balance for the portfolio. But again, maybe we may see some challenges in terms of our own sovereign debt markets in the coming months, quarters, and years. Excuse me. Maybe skip the next slide. It's really just talking about the S&P look at artificial intelligence. And go to slide 26, if you would, Kate. More recently, I had a conversation with one of the chief information technologists at one of a very prominent public equity firm, and I asked the question about artificial intelligence and how does it compare to, say, the internet that was, again, it came out in the late 90s. And he actually gave me the following quote. He likened the artificial intelligence to when the Titan Prometheus stole fire from Olympus and gave it to man. He said, this is incredibly transformational technology that will have a dramatic impact on our economies and our lives and our portfolios over the course of time. The question is, there's a lot of uncertainty associated with the rollout of these technologies. This slide in particular actually looks at artificial intelligence, or AI, as a word search in earnings calls. And you can see that it actually peaked in the third quarter of 2023, where everyone was talking about artificial intelligence. It's actually come off quite a bit more recently in the early part of 2024. Believe it or not, it's been replaced by Ozempic, and other weight loss drugs have been mentioned more prominently than artificial intelligence. But I believe it is certainly transformational technology that will have a significant impact on the world and something worth watching. On the next page, let's talk a little bit about the halo effect associated with artificial intelligence. And it's hard not to look at the market performance in 2023 without recognizing that the Magnificent Seven, all of whom have some stake or in some way touch artificial intelligence, how they significantly outperformed. As a reminder, the Magnificent Seven are the stocks of Apple, Alphabet, Meta, Microsoft, Tesla, NVIDIA, and Amazon. And Tesla seems like an outlier there, but it really, they're touching artificial intelligence has more to do with their automated driving. But the Magnificent Seven in 2023 average increase was 111%. Their collective gain was equivalent to 75% of the increase in the S&P 500 total. And at the end of 2023, those seven stocks were approximately 33% of total S&P 500 market capitalization. This slide actually looks at the expectations through 2024, where you see pretty much a flatlining in growth expectations or earning expectations for the Mag 7 and a decline in other markets, which we hope certainly won't be the case, and that the rally will be broader. And as I suggested earlier, that seems to be slowly working its way into the markets. Next slide, just a quick look at private equity, what I believe is a better business model, and this is an indication of that. Here we see the significant decline in the number of publicly listed companies back from, this is a 28-year chart that looks back to December 1996. And you can see at that time we had slightly over 8,000 public companies in the U.S. Versus, say, closer to 4,400 today. And a lot of that has to do with take-private operations and, again, perhaps a preference on the part of many public market companies to be private versus public. Interesting, also, we had the privilege of having Robert Smith from Vista present, again, at the Thought Leadership Speaker Series a couple weeks back, and he mentioned that software companies tend to dominate or be dominated by private ownership. He said 97% of all software companies in the markets today are private. Again, interesting. Now let's pivot a little bit to the NYCERS performance report update. We've tried to increase some of the slides or enhance some of the slides. Dan Haas has been hard at work. So on slide 31, Kate, I hope you're there. You can see actually your performance. It's nice to see a screen with all green on it, notwithstanding the fact that they're relatively short-term returns. But up top, you can see the NYCERS total plan return for the 3 months ending 2023 was fully 7.2%. That includes private assets as well. More importantly, you look at 5 years, and that 8.6% aggregate return is above your actually assumed rate of return of just 7%. So good news. Again, I tend to prefer a longer time horizon, 10 years or beyond, but again, a good result notwithstanding. On the next slide, here is a longer term slide, and it is 10 years, and it does look at longer term performance and puts in perspective, again, the compounding of 7% annual returns over 10 years relative to where the NYCERS portfolio is actually performed. And the good news is if you look on the far right-hand side, you can see that those compounded returns that you've achieved actually do exceed that 7% actually assumed rate of return target. So a good outcome and good progress, and hopefully that will continue in the future. On the next slide, I'll look at your net public market returns by strategy. Again, mostly green in this page. Looking at the last quarter of 2023 in the middle, again, positive returns across the board. And if you look at 3 years, again, considering the occurrence of market volatility and drawdown in many markets, including fixed income in particular, in the 3-year space, you still have negative returns, but again, more importantly, in 5 years, pretty consistently green across the board. On the next slide, I'll look at your net public market excess returns by basis point spreads. Here you can see, again, looking at 3 months, again, for the quarterly update, mostly red, actually, with some smatterings of green in there. And there's probably a justification for this. High yield benchmark returns actually came in quite substantially relative to active managers. Convertible bonds underperform because your manager is actually more defensive than that bond market index, which we think is a better position to be in. But again, it explains why it appears to have underperformance relative to the benchmarks. On the next slide, this is actually a new slide that Dan Haas has put together, which we think is very informative. It actually looks at your public market fees for the quarter and gives you a breakdown on the right-hand side. So in aggregate, if you take the $20 million quarterly fees by 4, it's over $80 million in public market fees to manage your assets annually. I think that the Bureau of Asset Management does a great job of negotiating these fees lower consistently over time. I don't necessarily believe we do a wonderful job presenting the progress and those efforts to trustees. So this is a start in an attempt to be better at that. But you can get a sense for the fees that you're paying on the right-hand side. U.S. equity fees you're paying for management, just 6 basis points. And the reason why that's so low relative to the others is in the U.S., again, because of market efficiency, passive management dominates. So you have about a 71% allocation to passive management relative to some of those other markets. Again, looking at developed market ex-U.S. at just 24 basis points. Emerging markets slightly more expensive from a fee basis at 39 basis points. And then your global exposure and your emerging and diverse managers at 47 basis points. If you look at the bottom in the darkest gray color, all strategies combined on a weighted average basis, you're paying about 14 basis points in fees across public market management. On the next slide.
Steve, if I could just
please,
interrupt for a
do you have a question?
Yep.
Yeah, please.
I just want to make the point that all 5 systems, and this slide is tailored to NYCERS, but if all 5 systems are showing, it's the buying power of the collective that is really driving this, correct? It's the driving power or the buying power of the $265 billion entity that is getting these low fees, right? It's not just NYCERS by themselves or BRRRR by themselves.
That's exactly right. That's exactly right, John. And now, to be candid, I mean, NYCERS is such a significant plan in terms of its size that it would garner very, very low fees regardless. But again, when you combine, I think it's over $270 billion in aggregate assets under management today, John. You're absolutely right. That's a very substantial pool of assets. And we are, again, dogged in terms of at every turn negotiating those fees down and down and down. Every single private market deal that comes through, we scrutinize at the investment committee. I think Anash and Pecha do an outstanding job as DCIOs, really focusing on aggregating those and achieving lower fees. Some of that's achieved through just negotiation, others through co-investment sidecars. But again, you know, we're trying to provide similar types of slides for private markets. I know Dan Haas is working on that. But yes, absolutely, it's the significant size and our ability to aggregate across mandates that can help us push down these fees. Let's see, moving to the next slide, unless there are other questions. Just a look at your net private manager returns by strategy. Here you can see private equity, again, in 1 year up 6.2%. Obviously, core and non-core real estate, they've been front and center in the press. Some challenges associated with office and retail space that have been marked to market lower. Some red there on a very short-term basis. More importantly, if you look at 10 years and since inception out on the far right-hand side, all positive, all green. And again, I think very successful outcomes there. On the next slide, a look at your private market excess returns and basis points. Now let me explain. If you look at the 1 year performance of our private equity relative to Russell 3000, you have to look at this and remember that the private equity market actually is marked to market, or the private equity holding rather is marked to market with a lag, comparative to, on a lag. Also, the Russell 3000 in 2023 was up fully 26%. So again, this still indicates over a 10% return in private equity, but certainly the snapback in public market equities has been quite significant following the 2022 drawdowns. On the next slide, and I'll be very brief on this slide, this is another Dan Haas production, which we're trying to, again, provide more insight for trustees into their portfolios. This actually looks at your private market exposure across what is actually invested today and in the markets, or in the ground, as we like to say. Assets under management in the middle, you can see across the asset classes. In private markets, you have fully $20,607 million invested. And you also have unfunded commitments where you've gone through the process, you've done the work, you've read the reviews, you've met with the managers, and you've approved new transactions to the tune of another $11 billion. Those monies will be called over time and put to work. And your total exposure, if you combine the two, what's in the ground and what is to be called, is over $31.7 billion, which is quite substantial. And again, a recognition of the good work that both the Bureau of Asset Management have done with the general and specialty consultants, but more importantly, the good work that the trustees have done in terms of vetting opportunities and making judgments in terms of if they're good portfolio fits or not. You can also see on the bottom just a different slide. We thought maybe pie charts were a good way of presenting the unfunded commitments relative to the assets actually in the ground today. Any questions on this slide? I know there's a lot of information here. Again, we're going to increase the transparency associated with everything we do, and this is just another starting attempt at that in terms of providing more transparency and insight into your private market exposure.
Steve, I have a quick question. Larry
Sure,
Bosley.
please. Hey, Larry. Morning.
Part of the reason, how are you? Is part of the reason that PE lagged relative to the benchmark, is that because of the lack of realizations and exits in 2023 from private equity?
I think, Larry, well, certainly that's impacting private equity. You're absolutely right. There's been a dramatic decline in M&A activity and exits and distributions. Although we have had some good distributions still, that's about, probably about a third to 25% of what we'd seen previously. So they have been very low. But I think it has more to do with the mark to market and the lag associated. Private equity tends to be less volatile. The observed marks in public markets actually occur on a daily basis versus quarterly marks that, again, tend to be a little more sluggish in private assets. I don't know that necessarily it's the distributions, but the distributions do provide an up mark. So when you actually sell a company, you actually realize that gain, you get distributions, but you also get that higher mark to market as an exit. So I think it's probably the combination of those two things, Larry, the mark to market and the distributions. We do think that we're seeing some thawing, I'd say, of the ice on the M&A market. I think the fact that base rates have come down from where they were, again, their peak in 2023 is helpful in terms of providing perhaps a little more impetus and cheaper funding for some of the deals that get done. Also, the fact that equity markets are back at or near record highs. I think what we're seeing is a reduction in that bid-ask spread between where companies want to sell their underlying holdings versus where they want to buy them. So hopefully you'll see more pickups. Yeah.
Yeah, we have one question in the room, or a comment. Tom, did you want to make a comment?
Yeah, I would just say, Larry, too, that for U.S. equity, that's the benchmark there that's being shown. It was up 26% approximately in 2023. So you see the negative excess, but it was a very strong year. And related to what Steve was saying, was largely driven by the Magnificent Seven. So over 60% of the S&P 500 return came from those 7 stocks. And that's why people are saying S&P 493 and then the other 7. So it does show how narrow the market was, and to say, well, yes, it was negative excess return, but in an unusually strong year and narrowly driven year.
But isn't the S&P 500 starting to broaden out over the last few weeks?
Yes, and actually, for instance, Tesla is decidedly negative so far this year. So it's not that Magnificent Seven story is not as clean anymore.
Yeah, they're not trading as a block as much, Larry. And again, Tom's absolutely right. You've had a couple of those firms that have had negative returns so far year to date. If there are no other questions, maybe one final slide, Kate, which is actually logistics at our rebalancing activities. Here, the bulk of what we've done in the fourth quarter of 2023 is really just to raise cash in order to meet benefit payments as well as capital calls for private assets. You can see that in terms of the cash desk at 950, that's typically what cash is used for, again, payouts and calls. And we've also done some rebalancing around the edges in our world equity positioning here and abroad. So again, just a summary where we are. We're going to try to provide more context. I should also mention, I know John Mercerberg and Robert Fang are working really hard, again, to rebalance the portfolios to your new strategic asset allocation targets and implement those changes. It is the single largest rebalancing effort that's been undertaken by the Bureau of Asset Management on behalf of the 5 plans at over $30 billion of money moving around, again, public to private, and within the public markets, there have been shifts as well. So we'll provide more details on that as we get closer to full implementation there. And with that, John, I don't have any other formal remarks. I'm happy to take any questions.
Any questions related to the quarter? Or any questions on Zoom? All right, hearing none. Thank you, Steve, for your presentation. We next have a companion to that presentation, which is the risk report. So Ed Berman, our Chief Risk Officer, is going to take it away. So Ed, the floor is yours.
Thank you. Good morning, trustees. So if I were to summarize what we're all trying to achieve is to deliver the best risk-adjusted returns. And returns are much easier to understand and visualize. Steve just did a wonderful job walking us through the last quarter. The risks are more complicated. Intuitively, we all understand what risks are, but with so many things happening in the world, with markets, companies, interest rates, it's very hard to bring it to a single number. So for the purpose of the discussion, I'll be talking about risk in terms of the expected or forecasted returns. And I'll be using these terms interchangeably, risk and return, much like we talk about 2 measures of returns. They are total returns and the excess returns, with excess being the measure of your managers. We're talking about total risk, which is a measure of total returns, and active risk, which is the measure of expected excess returns. So your portfolio is a mature, well-developed portfolio of $85 billion. You employ about 110 public managers, close to 350 private funds. So that thousands and thousands of people who make decisions, who touch your portfolio, and whose inputs makes the difference, but also creates the risks. But actually, if you need to have a high picture of risk, what's happening in your portfolio, just two things you need to know. First of all, it's volatility. And what I mean by that is how much prices change on a daily basis, moving up and down. So here on the screen, we have two measures of volatility. First of all, starting with chart number 1 on the left-hand side, it's the VIX index, which is the volatility of equities. And here we show the last 5 quarters, and you can see that the volatility is trending down. The way this chart is presented, it shows a typical range of volatility. You can see that in Q4, the volatility was almost unchanged. It moved closer to the bottom of the range, meaning markets are normalized when a steady environment. Everything is calm. On the right-hand side, you see the MOVE index, which is a measure of the fixed income volatility. And that's where the picture is different. So clearly, if anything, you can say we're in the mid-range. It's not normal. It's not a panic state, but we're clearly not out of the woods. And you can see that in the past 5 quarters, the volatility has been probably steady, slightly down. So we're still in a very unusual environment, and the risks are elevated. So the second thing you need to keep in mind, besides volatility, next page, is the stock-bond correlation. And what I mean by this is just the relationship between the stock prices and bond prices. So when we say stock-bond correlation is negative, it means when stock prices go up, bonds go down. So bonds present a natural hedge. They reduce the chance of drawdown. It's like a cushion for your portfolio. In a positive stock-bond correlation, the opposite happens. It's everything crowds, everything sells off, meaning there are more risks to your portfolio. It may work in your favor if everything goes up, but it's not the environment we want to have. And there's an implicit assumption kind of baked into the strategic asset allocation for your system that the stock-bond correlation is negative. As a matter of fact, I would make a statement that probably all portfolios for all pension systems globally have these assumptions baked in. And that is so because if you look at the chart number 1 on the left-hand side of the page, here we show the stock-bond correlation for the past 20 years. So you can see that right now, the correlation is positive. But far and beyond, through the majority of the 21st century, the correlation stayed negative. So what drives this correlation? The short answer is inflation. And on the right-hand side, you can see the same period, the inflation trends. And broadly speaking, there are 3 regimes, 3 environments we experienced in the 21st century. Before the global financial crisis, before year 2008, inflation averaged about 3%. After the GFC, before the pandemic, you can see the blue line, inflation tend to be around 2% or lower. And then, of course, in the current environment, as well, no inflation is elevated. And you can see how these 3 regimes map into the stock-bond correlation. A 3% inflation means the stock-bond correlation about minus 0.25. Inflation moves lower, stock-bond correlation improves. Now, in a high inflation environment, the stock-bond correlation is positive. And that's why we believe that it's a temporary environment. We believe as inflation normalizes and it's coming down pretty fast, we expect the stock-bond correlation to normalize as well and move in the negative territory. But since this is a risk presentation, of course, I need to highlight the downside scenario. Can we have the next page, please? So if we take a big step back and look through a longer period of time, so this is a chart in a recent academic paper. It shows the stock-bond correlation from the beginning of the 20th century. And the first thing that jumps at me is that before the year 2000, the stock-bond correlation was actually positive. It was a normal environment to have positive stock-bond correlation. You can see that there were environments of high inflation, low inflation, deflation. It didn't really move the stock-bond correlation that much. So what gives, and the answer is, it's actually more complicated. What determines stock-bond correlation is not just the inflation, it's the uncertainty around inflation. It's uncertainty about inflation, about the GDP growth, and the main difference we see in the 21st century is a more activist role of central banks, the Federal Reserve's here, European Central Bank, and other banks globally. That's what really created a more stable, more predictable environment that will drive stock bond correlation lower and makes it negative. If you think about your portfolio, and that's again something we'll watch in the background, just to give an idea, if the stock bond correlation moves from minus 0.5 to plus 0.5, it means about 20% pickup in risks for your portfolio, which means again, to have the same level of risk, we would need to cut down the equity exposure, which means lower returns. So you can see this is one of the critical inputs in your portfolio. Again, something to watch very closely. And the areas in your portfolio help to cushion for the stock bond correlation, mostly the private assets. We just talked about the delay, the lag in the private valuations. It's real. That's one of the reasons why we like private assets. We expect superior returns, but they also help with this part of the portfolio. So it's an important risk, again, something to keep in mind, and something to watch behind the scenes. So with this in mind, giving this kind of broad market context, what is the risk of your portfolio? Next page. And you can see it at the bottom right corner of this table. The risk for your portfolio is 11.5%. Again, what I mean by this is the expected performance in the next 12 months will be in the 11.5% range. I cannot tell you if it's positive or negative. I can only give you the magnitude. Again, the important question, is it a good number, bad number? Should you worry? Should you panic? Or give it like sense of calm? So to put it in perspective, we'll kind of take a step back and we'll talk about 3 portfolios. Same thing we talked last quarter. Starting with the market portfolio, it's in column 1 of this table. And it's really a very simple blend of 65-35, 65% of broad equity measure, MSCI ACWI, All Country World Index, the broadest possible equity measure, and 35% of Bloomberg Aggregate, which is the broadest domestic fixed income measure. So this portfolio, which is really just the market, has the expected risks of 11.1%. This number was produced using our risk system, Bar 1. And keep this in mind as your baseline. That's what markets give you. That's the result of this VIX index, MOVE index, correlations, all decisions made by all the people. Moving from this market portfolio to your strategic benchmark, policy benchmark in column number 2, that's where we introduce all 12 asset classes go into your portfolio. And you see that the risks of this portfolio is 10.5%. Again, we're talking about expected performance. The number is lower, partly that because of diversification from the strategic asset allocation, part of it from introducing some lower risk asset classes such as infrastructure and real estate. From there, we move to column number 3, and you can see that this number, 11.5%, first of all, is consistent with the market. It's consistent with the benchmark, which means that your portfolio will perform similar to the market. That's what we expect. So it's a good outcome. That's what we hope to see. The other conclusion is that the returns of your portfolio are driven mostly by markets. It's a long-only portfolio. It's not surprising. But the majority of returns, if we spend so much time on choosing managers, private deals, the majority comes from the markets. And lastly, for this page, just want to draw your attention to 2 charts on the right-hand side. That's where we show the historical trends in this portfolio. History is important to understand the risks. Chart number 1, total risk. You see that the relationship between these 3 portfolios has been very steady for the past 12 months. And the trading down with market volatility, as we just discussed. And lastly, chart number 2, which is active risk, a measure of excess returns. Again, steady level of exposure, nothing unusual, slight trend downwards as markets normalize. So this is the highest level check of kind of health of your portfolio. Like if anything, any big problems in your portfolio will show up in these numbers. And currently, we don't see any. So let's just dive into these numbers. That's it. It was a very high level view. Let's just see what's behind them. We talk about 2 measures of risk, so we'll have 2 parts to the discussion, starting with total risk, which is again measure of total returns. On the left-hand side, you see your strategic asset allocation. It's still old SAA. We're in the Q4. And this is well familiar to everyone. It's a blend of three asset classes: public equity, public fixed income, and alternatives. On the right-hand side is what we call risk allocation. So it's actually the breakdown of risk. It's 11.5%. That's what drives the returns of your portfolio. There's not much change from the previous quarter. These numbers are fairly stable. We watch it all the time. But you'll notice that how different this chart is from the strategic asset allocation. This blue band, public equity, now 62%. And I think it's all of us. We spend a lot of time in private deals. They take a lot of time. It's an important part of the portfolio construction. I think overall we need to pay more attention to public markets because that's ultimately what drives the majority of your returns and drives the majority of the risks in your portfolio. And I keep talking about risks and performance interchangeably, which in a way they are. So it's important to connect the forecasted risk, forecast performance, with the realized returns. And that's exactly what you see on the page. So just to walk you through the charts, the vertical bar represents the risk forecast, the forecasted performance. The blue triangle shows the realized outcome. Starting with chart number 1 on the upper left corner, the first bar refers to your portfolio, NYCERS. So you can see that the realized outcome is well within the forecast. So it's a check. You see that public assets realized a very successful outcome, both equities and fixed income. Chart number 3 shows you the breakdown of equity returns. US equities, developed ex-US, delivered in excess of expectation. Emerging markets, very positive outcome. Fixed income, chart number 4. Again, everything is good or better. And that's actually consistent with the broad environment and the narrative in the market. If you think about what was happening Q3, Q4, and even now, we started last year with an absolute certainty of moving into recession. The odds of recession were 100%. Slowly, this 100% got to be questioned. Turned out it was not 100%, and we moved towards a soft landing narrative. And now the narrative is more soft landing and takeoff. So it's not something that markets expected or our managers expected, and that's why the realized returns are much better than the forecast. And again, something we watch very closely, even though we do asset allocation once every 3 to 5 years, this is one of the checks that we monitor internally. And if your asset allocation is not performing well, it would show up in this chart. Again, something we watch, but so far it looks good. So the second dimension of risk and performance is what we call active risk, which is the forecasted excess return. And that's, of course, a check on your managers. Again, you have hundreds of managers, thousands of people. It all comes together in this chart. So here we show the breakdown of active risk, meaning the breakdown of the expected returns you may get from different asset classes. And by far and beyond, what jumps at me on this page, it's mostly about private assets. So we do spend a lot of time on private assets, and it's for good reason. It's a big driver of returns. And in a way, it's not surprising, given that private assets are somewhat unusual or unique for public markets. We benchmark private equity against the Russell 3000, even though we're well aware there are very different strategies in different markets. But it's probably what's more interesting in this chart is fairly low contribution from public markets. So you can see that public equities contributed about 20 basis points, public fixed income contributing in single basis points to this risk. And I just want to highlight it's one of the ongoing active projects within BAM to understand these numbers better and to see if we can come up with a better mousetrap, better portfolio construction process to improve these numbers. So I'm sure we'll highlight to the trustees when we have more certainty on this project. And again, we talk about the forecasted risk or performance. We need to connect it with the realized performance. The same chart we just saw for total risks. So vertical bars represent the forecast, the expectation. The blue triangles here represent the realized outcome. So that's obviously all your managers brought together in one place in a single number. It's a check across all of your managers taken together. And you can see, starting with chart number 1, the first bar labeled as NYCERS, that's your portfolio. The excess return is well within the expectations. So it's like the highest level check on your portfolio. You can see that private assets delivered probably well within expectations, slightly lower, and that's again related to discussions we just had about the performance. And as a risk person, I actually see it as a positive thing. This is this diversification we talked about, the correlation. That's where private assets cushion the portfolio. May not always work out quarter after quarter, but over long term, it adds up. It's helpful. But look what's happening in public markets. Equities performed well, and I wish it was a story for you in developed ex-US. You see developed ex-US performed very well above the expectations, but it's really many small things came together. It just worked. In fixed income, you can see that essentially all asset classes, core fixed income, high yield, they performed below expectations. And I just want to go back to the discussion we had about total risk, about this 100% recession expectation, soft landing takeoff. Your managers were expecting much worse economy, so more defensive in their positioning. I'll defer to Robert to talk more in details about fixed income. But broadly speaking, they were more defensive in terms of credit exposure, they went to shorter maturity, and they underperformed. Longer term track record is more positive. Again, here we're talking about from the risk perspective. Nothing bad is happening. It's all positive, just the outcome. Again, internally, we do a much more thorough analysis at the individual manager level. And so far we talked about the past. Of course, we're more concerned about the future. So we cannot talk about risks and not to mention the future world, which of course is unpredictable and unforecastable. So recognizes this first step in talking about the future is kind of formalized the possible market shocks. So we don't know where they're coming from. So instead we're talking about equities, rates, and commodities. So these three broad buckets taken together make the totality of markets. So you're not investing in commodities, but you cannot escape commodity exposure. It's a lifeblood of the economy. And in each of these buckets, we select three most important products. I'm not going to read this chart, just to highlight briefly chart number 1 on the upper left corner. It's the chart of the S&P. And our risk system forecasts a pretty strong outcome. So it shows that S&P can go between 6,000 to 3,700. Right? So we don't know what the future will be, but we go to our risk system, ask the question, what may be the worst possible monthly outcome for the next year? And just this chart was put together a few weeks ago. Just during this time alone, the S&P rallied from 4,900 to 5,100. So the world keeps changing, but it's important to keep in mind it can go in either direction. And finally, chart number 9 at the bottom right, that's inflation. And that's, of course, inflation is the story of this year and probably this decade. Inflation normalized significantly. When this chart was put together, it was at 3.1. It moved slightly high since then, 3.2. But again, our risk system sees fairly dire potential outcomes. So you can see it may accelerate over 5% or slow down close to 0. Again, very broad range. And it's important to understand how your portfolio will perform in this broad. And here are the results. So for the same 9 markets, we identify the shocks. They're shown in next to these markets. And then we show the absolute returns and excess returns. Both are important. They tell a slightly different story. And we show you the risk on environment when everything rallies or risk off when everything sells off. Now, the important thing to keep in mind, all these shocks are equally likely. That's how we calibrate them. And when you look at the response, you can get an idea of whether your portfolio is most sensitive to. So starting with equities, the first bucket. Clearly, the S&P at 14.9% is the most important asset class for you. I hope it is not a big surprise here. But look at the second line, emerging markets. close to 13%. Look at Europe, 13.7%. Just to remind you, emerging markets, there's a 5% allocation. It's important to keep in mind that even though we have not that many assets in emerging markets, the world is connected. If there's an emerging market crisis, we cannot hide from it. And that's what this chart highlights. Still, it's important to see that the S&P is your largest exposure. In the rates, the 2-year Treasury, we use it as a proxy for the Federal Reserve, Federal Reserve rate policy. And you can see it's actually the lowest number on the page, 1.3%. Your portfolio is actually not that much sensitive to the Federal Reserve policy. It's obviously the focus of the stories, but there will not be that much action in the portfolio. What's important? It's actually the euro-dollar exchange rate. If dollar sells off, your portfolio appreciates. It's actually one of the largest impact for your portfolio. And lastly, in commodities, it's the copper that's most important. Again, to remind you, copper is one of the most important commodities that goes into anything. Artificial intelligence cannot run without computers without wires. That's copper. Cars cannot drive without copper. Everything requires copper. So put it all together, your portfolio more sensitive to the S&P, the softness in dollar exchange rate, copper prices. It means that you're positioned pro-growth, pro-development, and it's probably not a bad place to be. So altogether, I see it as a positive outcome. And lastly, just to summarize, we'll watch the trends in these numbers. Next page. And trends are important. They tell you the story. They can highlight any changes and can show you some areas where you can focus on. So here we show the trends for the past several quarters. And these are negative numbers. We'll look at the stress loss. Obviously, moving closer to zero, moving up, means the risks come down. So chart number 1, equity stresses. Just as you expect, the world is normalizing, the losses come down. Commodities, chart number 3, the same story. In fixed income, the story is somewhat different. Chart number 2. This one line that looks very different from the trends, and that's the 10-year Treasury. And that actually highlights a very interesting story. So the rates moving down, the world getting better, but the shape of the yield curve is changing. The curve actually became more inverted in the Q4. And this inversion of the curve what drove an increase in risk for your portfolio. And I thought it's a good story to highlight, as I mentioned before, the world is multidimensional. Many things can go wrong. You cannot hide from risk. You don't want to hide from risk. That's what makes the returns. But it's important to keep in mind the totality of markets and understand the entire system. Everything is connected. So I'll pause here, and any questions we'll be happy to cover.
Ed, it's Steve. If I can just make one further comment, I think you raised an excellent point earlier that we typically spend more time at these trustee meetings talking about private markets, but public markets are really substantial allocations at 68 to 70% of your portfolios, and we do intend to spend more time on them in terms of presenting our performance and other metrics there. I know that Ed and team are working on a much more comprehensive package of rigorous quantitative tools that we can bring to you over time. So again, I think Ed did a great job highlighting the importance of public markets relative to private markets. They're all important, but again, I think we've been perhaps not as diligent in terms of presenting where we are in public market exposures and opportunities.
May I ask a question? Hi. I had thought, traditionally over many years, it was always my understanding that oil was the most important commodity because it flows through every point in the system and it's not easily substitutable. So surprised to hear that copper, you say, is the most important commodity. So just what are your thoughts, oil versus copper?
They're all important, they're all different. So the issue with oil, you're absolutely right, it's one of the central commodity for global economy. but the use of oil is fairly constant. There's not much elasticity. The cars need to drive, planes need to fly. So there's a certain demand for oil that tends to be fairly steady. Copper is more discretionary. You don't need to buy a new computer. You can wait. You don't need to buy a new electrical car. You can drive your old car, right? So you buy these products and this extended manufacturing of these products only if the economy is expanding. Right? So people invest for the future. That's why copper usually, not that it's more important, it's a better indicator of economic activity. It's a better measure of risks. Because if we measure to oil, price of oil is probably more driven by Russia-Ukraine war, by the Houthis attack in the Red Sea, disruption to the shipping, right? It's more responsive to the supply, less to the demand side. Copper is the opposite. So that's why we focus on copper more for this analysis.
Just a follow-up question. What about the importance of the so-called strategic minerals? Because those are very important, right? Lithium and lithium is the one that I hear the most about because of its importance for battery manufacture.
Look, it's all important, right? So if you think about batteries, so yes, it's lithium, but also a whole range of other components that go into it, and also manufacturing components. But specifically with lithium, if you think about batteries, I think it's close to 90% of global capacity is centered in China, right? And also lithium deposits are mostly in China and Chile. So in a way, China makes like a closed ecosystem for manufacturing of batteries. From this perspective, unless we move manufacturing domestically, we don't really need lithium by itself, right? So it becomes a more complicated story that brings a lot of components together. And again, like when we look from the risk perspective, try to identify the drivers of economy, that's why copper is such a beautiful example. It's plentiful, it's mined in many places in the world. It's used in manufacturing globally. So it's more of a kind of fungible commodity. Lithium, you're absolutely right. Strategically, it's critical. I think there's a big weakness domestically, and we have a huge gap in capacity to produce these materials and also manufacture from these materials. But that's a different story. It's a different type of risk, not the risk we're talking about today.
Yeah, I have a question. When you talk about commodities, are you talking about it as an indicator of the effects on our investments in equities and fixed income, or are we actually in commodities?
No, you're absolutely right. It's more the impact on the markets. So it's an indirect impact on your portfolio. And I think that's what the importance is, even though we tend to focus on more obvious measures, right? We have that many stocks, that many bonds, this is the duration, so we can measure this. The reality is more complicated, right? So the reality is that everything is connected, everything drives the portfolio. That's why we try to kind of broaden the perspective here to bring it to focus.
I think we have another question on Zoom, Russell.
Yeah, thank you, Allison. Sorry. Engaging conversation on commodities as well. Ed, I was wondering if you could go back to a couple of the slides, particularly the one about the rolling 10-year correlation between US equity and treasury returns. That one just struck me as very interesting, and I don't think I completely understood the takeaways or implications. It just struck me as, I thought we had just entered a world where the correlation between stocks and bonds had just turned positive. And of course, I see that short uptick at the right side of that chart. And obviously, this is a rolling 10-year correlation, but I didn't realize, maybe it's just my green youth, I didn't realize that stocks and bonds had a positive correlation for almost the last century, before the last 20 years. I was just hoping that maybe quickly, I recognize that we're already behind time quite significantly, but if you could just kind of reiterate the takeaways from this slide. I think you had tied the last slide into this one as well, but this one really intrigued me.
Well, actually, you're not the only one to be surprised. I think I would say probably a lot of people in the market would be surprised as well. And it's also a reference at the bottom of this page to the paper where it came from. It's a recent paper. It's well worth the read. It's a very good analysis. So the point of this is, as I mentioned before, there's a common narrative that inflation drives the stock-bond correlation. And it appears to be so if you look at the more recent history. Obviously, this chart kind of disputes that and gives very strong evidence that the picture is more complicated, right? And the theory or the explanation put forward by this paper reference at the bottom of the page is about the uncertainty about the GDP growth and uncertainty about the inflation, and also the interaction between these two types of uncertainty. That's what drives the stock-bond correlation. And probably one of the most important developments in the 21st century, late 20th century, is the evolving role of central banks. So we hear a lot about the central bank balance sheet. I think it's a very complex question, which could be debated for days and months, and people do that. We have these debates internally. But the important thing to know that as balance sheet is growing, central banks getting more and more involved in the managing the economy. And again, people debate whether it's a good or bad thing, but one thing is certain, that it reduces the uncertainty. Just think about the current inflation environment. If we look at the long-term inflation expectations, they barely moved. So by far and beyond, people were confident that inflation will come down. I'm not talking about market participants who trade tips and other instruments. We're talking about Michigan survey. These are real people, real economical actors. And to a large degree, this is because of central bank involvement. And I think that's the factor that most critical for the stock-bond correlation that drove it into the negative territory. And again, I want to highlight it because it's an important input into your portfolio, and it's not often appreciated as like one of the key risks. I don't know if it answers your question, but it's probably.
No, it does. I think I just needed to hear you talk me through this slide again. I appreciate it. Thank you.
Russell, if I can also add, I think that I had the same questions when I saw Ed's slide. I thought he had it upside down. But the fact is that the equity and bond prices aren't perfectly correlated, that there's still a diversification benefits. And if you look at Markowitz's study that was done decades ago, it actually occurred at a time when there was positive correlation, but not perfect correlation. So I still think that diversification benefits associated with not perfect correlation, I think certainly benefits the portfolios.
Absolutely, and also the role of private assets. That's very helpful.
Yes.
Besides high returns.
And the role of private assets in this context is almost as ballast and lack of marking to market constantly.
It's not even mark to market. It's more of a delayed valuations. So to give you an idea, for example, if you take just the Russell 3000 index, delayed by 3 months and correlate with itself, the correlation will be minus 0.3. So just the fact that there's a delay creates a very strong diversification benefit, and it's broadly positive for the portfolio.
Thank you.
There might be other factors as well that advantage private assets over public in terms of the ability for private equity managers to align the incentives appropriately with management companies or portfolio companies. I think is very strong, and I think that chart, I don't know if you were on for that, Russell, but where it showed the decline in public companies from over 8, that the private ownership model certainly has value in many different ways.
Yes, I saw that one
And
as
again,
well. Thank you.
Again, as we strike that balance of private versus public, we want to make sure that we're consistent in terms of allocating it across public and private assets.
Thanks, Steve. Thank you, Ed.
Sure.
Thank you.
Okay, so that concludes the quarterly and the risk. I want to turn it over to Liz to make some acknowledgements, and then we're going to bring up John Adler.
Thank you. We just want to note for the record, the following 4 NYCERS trustees have joined the investment meeting. Elizabeth Guzman, Public Advocate's Office. Keisha Sutton James, Borough President of Manhattan. Karina Lozada, Borough President, Brooklyn. And Larry Bosley, International Brotherhood of Teamsters.
Thank you. So with that, we're going to continue along the public session, and I'm going to invite up the former chair of NYCERS and former facilitator of many board meetings, John Adler. Welcome back to NYCERS. Chairperson Adler. I believe we still use your highest title in the diplomatic corps. So welcome back to your old home at NYCERS, and I hope the commute here from the 8th floor was great.
Thank you, John.
And John, maybe just tell people what you're doing now. maybe just I guess, but just by way of background. So John is at the Controller's Office. Obviously, he is the Chief ESG Officer. Amongst many of the things that he is responsible for is our progress on net zero. And John, I'm going to turn it over to you to kind of walk us through what we have this morning.
Okay. Thank you. Thank you, John, for that warm introduction. Good morning, trustees. It's a pleasure to be here. And truthfully, all the times I've been in this room, I've never actually been at this podium. And we seem to be having a problem with the slides. So we're going to fix that. But so I'll just jump right in. So what I'm going to do today is a brief overview of the 2023 annual report on climate and net zero, which is, has been circulated to you. And then I'm going to go over 2 sets of recommendations stemming from that report and the net zero work that has been happening at NYCERS and BRRS. And here comes our, thank you, here comes our slide. So if we can go to the next slide, starting with the annual reports. Next slide, perfect, next slide. Okay, and we're going to start, if we can see the slide, with the carbon footprints, right? So part of our program is we annually measure the carbon footprint. I think that's 1 slide too many. If you can go back 1 slide. No, okay, that's fine. You can start with that slide. A little bit tough to see, but go ahead. You can go to the next graph. So the unsurprising but not great news is that the scopes 1 and 2 carbon footprints for the public equity and corporate bonds portfolios in fiscal year 23 increased. So this is the NYCERS report, and you can see that this scope 1 and 2 footprint increased by 12.4% from the previous year. So that leaves the fund about 20% short of the 2025 goal of a 32% reduction in greenhouse gases by 2025 from the 2019 baseline. We're still well below the 2019 baseline. We're about 12% lower, but we need to get to 32% by 2025. So now this data is from the end of the fiscal year, so June 30th. So, it goes back a ways, and hopefully the data will improve this year. But the reality is that, the climate is still warming, and greenhouse gas emissions have not gone down yet. And so that's just kind of the reality that we're dealing with, and we're trying to do our best to affect it. But we really are, just like with our investment performance, we are very much tied to what happens in the market. Same thing with our greenhouse gas performance. If you go to the next slide, I'll just show you the BRRS thing, which is very similar. BRRS increased by 6.43% in fiscal year 23. That leaves that fund 11% short of its 2025 goal of a 22% reduction. We go to the next slide. Now I'm going to shift to some high-level results from the ESG questionnaire that we did of all of your managers last year. So here's some high-level results. We asked the managers to report on whether they measured the greenhouse gas emissions of their portfolios, whether they have adopted or intend to do so in the next 18 months, at least for the assets they manage on your behalf, a net zero goal, science-based targets, and/or other decarbonization goals. So here you can see the results for both funds. NYCERS is in blue, BRRS is in green. And the reason we talk about funds and not managers is some managers manage multiple funds on your behalf, right? Both on public markets and in private markets. So in some ways, maybe the best measure is the assets under management, which is the 3rd and 4th column, or the last 2 columns on the right there. So you can see that managers of 47% of BRRS and 40% of NYCERS AUM measure scope 1 and 2 emissions. the current percentage of AUM that either has or intends to set net zero goals or other decarbonization goals is 48% for BRRRRs and 40% for NYCERS. Those numbers are not on there. That's an amalgam of the kind of the last 3 rows on that chart. So now both boards, NYCERS and BRRRRs, have set expectations that all of your managers are going to adopt net zero goals by 2025. So right now is less than half, right? So we've got a ways to go. And we are engaging with your managers now to delve more deeply into these results, how they reported, where they're at, and clearly communicate to them the board's expectations that by the end of fiscal year 25, so essentially a little bit more than a year from now, they have adopted net zero goals. By the way, let me just be clear that the expectation for private markets managers is that the funds that you invest in after that 2025 deadline will be net zero. So the current funds, they can't go back and change what they're doing currently, because that would require the agreement of all the limited partners in a fund. So that's a prospective commitment that we're looking for those managers to make. We'll be sending out this year's questionnaire over the summer, so we'll see how these results evolve over time. There's a lot more data on the managers' responses to the questionnaire in the report itself. So I encourage you to take a look at that and see for yourself where your managers are out. If we can go to the next slide. So this slide shows the percentage of your public equity and corporate bonds portfolio that has adopted science-based targets as of June 30th, 2023. So your goal there, to repeat, was that we have 70% of those portfolios having adopted science-based targets by 2025. And so on this chart, the blue bars represent the percentage that has been validated by SBTI, the Science-Based Targets Initiative. That's the international organization that validates these targets. And the orange is the percentage that have committed to SBTI but have not yet been validated. So for both of you, both boards, the totals more than doubled during fiscal year 23. But again, they're in the around 36, 38%. So we have a long ways to go to get to 70%. So we're hard at work on that engagement with portfolio companies directly. We can go to the next slide. So now I want to go over some of the highlights of the portfolio company engagement over the past year. We started with utilities, since that's one of the highest emitting sectors and also one where technology exists to reduce emissions. We sent letters to 35 utilities in which NYCERS and BRRRRs own shares, demanding that they adopt science-based targets. What has followed has been an extensive engagement with the companies themselves, with their trade organization, the Edison Electric Institute, and with its associated research organization called EPRI, the Electric Power Research Institute. So this is an ongoing engagement around science-based targets. Honestly, I don't know exactly how it's going to turn out, but we are extensively involved, and they are sort of welcoming our engagement with them on this science-based targets process. We're about to send similar letters now to materials companies in your portfolio, which is another of the high emitting sectors. And so we're kind of moving through the high emitting sectors one by one. This is a very intense, complicated process, but we're committed to carrying it out. The implementation plan also put a major focus on banks. Last year, on your behalf, we filed proposals at 5 banks that drew relatively low shareholder votes, averaging 13.5%. This year, we filed proposals at 6 banks, calling for them to disclose clean energy supply ratios. And each of those banks we've engaged extensively with, and JP Morgan and just yesterday, Citi have agreed to disclose their ratios this year in exchange for us withdrawing these shareholder proposals. This is real progress. There's an article in the Financial Times today about this, which I encourage you to take a look at. We expect the votes to go forward at the other 4 banks, Morgan Stanley, Goldman Sachs, Bank of America, and Royal Bank of Canada. And we're hoping that we're going to get a good, strong vote to get those banks to move in this direction as well. Next slide. So under the implementation plan, you charged BAM with recommending quote, an initial approach to supporting a just transition in the investment process consistent with fiduciary duties by the 4th quarter of 2023. So that initial approach is contained in this annual report. We're 1 quarter late. Apologies. You know, we've taken the approach on this work in this implementation plan that better to get it right than to, make sure we get it to you on time, to be honest. This climate work is a long time project, so we'd rather get it a quarter late. We did the same thing with the implementation plan last year. That was supposed to be by the end of 22. We did it in the spring of 23. So it goes. The Controller's Office put a lot of work into this just transition effort. And as, okay, I already said that. The report, this annual report, has 3 pages on just transition, starting on page 15 of the report. This slide shows the definition of just transition we have adopted. We know this is a very important topic to the trustees, so I encourage you to read through this section, and if you have suggestions as we further elaborate this initial approach on just transition, we would love to hear from you. Okay? Next slide, please. Last year, BAM fully implemented the board's directive from the implementation plan to exclude prospective private markets investments in upstream oil and gas by adding language to the side letters for these investments. So in the side letter provision, managers commit to either not make such investments or provide the boards with opt-out rights if they end up making them. So that's in place for all of your private markets investments as of this fiscal year. Okay, so that concludes my overview of the annual report. Again, I encourage you to read through the whole thing. It is long, but there's a lot of very pretty charts and graphs. So if not, at least read the executive summary, and then you get the gist of it. Any questions now on the annual report before I move on to the recommendations?
John?
Yes.
On the asset manager engagement.
Yeah.
How forceful do you expect to be with prospective managers? Like, we're in the middle of a search for non-US equity.
Right.
Is there a way to encourage them by holding a carrot in front of them?
Well, here's what I expect. We are communicating this expectation to all the managers, but the way the expectation works is ultimately the board has the authority whether to hire managers or not. So if BAM is recommending a manager that says no way, no how on net zero, we will communicate that to you. And so, it'll be up to the board to say, well, why should we pick this manager that won't do net zero compared to this other manager that does? I honestly think that's going to be less of an issue than with your existing managers, because if you have existing managers who say no way, no how, and we come back to you and say, well, here's this manager, and they are not agreeing to your expectation that they have net zero, then you're going to have to make a judgment consistent with your fiduciary duties as to whether to retain that manager or not. And, keeping in mind that for public markets managers, you have the ability to terminate a manager anytime you want. Private markets, it would be for re-ups.
John.
Yes, Larry.
Close question to the one that was asked. What is the percentage of managers that are responding to your survey so that you can have a really accurate?
It's like 97% of AUM responded. And I think it's 95% of the count. Truthfully, the only ones that don't respond are what we call the runoff managers, which are old managers in private markets that we haven't re-upped with, and they know we're not going to, so they're like, why bother?
So can I just make one point?
Yes, Jeff.
There was a reference to the non-US search that is still ongoing. I just want to just go on the record to say all of the searches that are conducted will be scored within the confines of what's allowable within the policy procurement rules, and it's a very strict process. So I just want to be mindful that everything we do is conducted within those guidelines. So if there's an ability to ask additional questions or to ask for follow-up, I just the inference of the carrot. I just want to make that point clear, is that that everything that gets done is within the confines of whatever's in the rules and permissible by the scoring group as well as the trustees. So just in case
Thank you,
anybody's
John.
zooming in.
Thank you for that clarification. Keeping me to the straight and narrow as usual.
John,
yeah.
Otherwise that would be known as the carrot versus the tire iron approach.
Keisha, did I see a hand?
Yeah, I did. Really quick question. I apologize if I missed this. The where you are now, the 40 and 47% who have adopted versus where is that? How does that compare to where you expect it to be at this point? I know that we're supposed to be at 20, 25.
Honestly, I don't know. This is the first time we've asked these questions because we did it in the wake of your adopting the net zero implementation plan. So, I mean, on science-based targets, we made a lot of progress last year. I think you're asking, you're not asking about science-based targets. You're asking about the manager engagement, which I think was the previous slide. Yeah, that one. Yeah. So honestly, I don't know. I was a little surprised that more managers didn't say, we intend to do so in the next 18 months. So that was a little surprising to me. And that's really the questions that we're going back to these guys who said no, and we don't intend to in the next 18 months, to say, hey, our expectations, the board's expectations are that you're going to do this. So are you telling us you're not going to do it? And we need to sort of, the thing about questionnaires is there's a drop-down menu for answers. So maybe there's a little bit more nuance to their answers, and that's what we're going to find out by conversations. So, and we're committed to giving you a progress report this year really, for 2024, manager by manager. So we will do that in our report for this year, either at the end of this year or the beginning of next year, so you get a better sense.
And John, the next one, I believe it's the next chart.
The science-based targets chart?
Yeah, so that's a different lens where, the way I understand it, for this chart, what we're seeing is...
That's portfolio companies.
Right, so equity, equities and corporate bonds.
Right, it's based on our financed emissions, right? So what percentage of our financed emissions in the equity, public equity, and corporate bonds portfolios have adopted science-based targets? That's what that is. Thanks, Tom. Any other questions on the report before I move on to the recommendations? Okay, if we can move on to the that one, perfect. Climate solutions investments. Okay, so this is the first recommendation, is concerning your investments in climate solutions. So what we have today is an interim update on your exposures to climate solutions as of the end of calendar year 23. And we're also going to propose new 2030 targets for climate solutions that are based on your updated strategic asset allocations from that you just adopted, including the capital markets assumptions that underlie those asset allocations. Also updated actuarial projections that we got from Merrick for the system's assets under management in future years. And then we continue to employ the same compounded annual growth rate, or CAGR, that we used to generate the earlier targets when you adopted them, which was in 2021. So we can move to the next slide. Okay, so this is for both NYCERS and BRRS. So the current exposures to climate solutions, for NYCERS, it's 3.7 billion, which is just below the 2025 goal of 4 billion. And truthfully, given the run up in the equity markets, that number is including public markets as of the end of 2023. My guess is when we include the private markets that we don't have the counts for and the run up in the public markets, NYCERS is probably over the 4 billion as we stand here today. Okay. For BRRS, you're already over the 2025 goal of 400 million at 495. And And you see across the 5 systems, the exposure as of the end of 2023 is 11.4 versus the 2025 goal of 11 billion. Okay, so these year-end numbers do not include private equity, alternative credit, and real estate because they're not available yet because, you know, they're reported on a lag. So given the levels you are at now, we're proposing that you adopt new public 2030 targets. So you never adopted 2030 targets when you adopted the previous goals. We adopted interim 2025 targets and sort of quote unquote final 2035 targets, but we didn't do 2030 targets at that time. When the board set those goals in 2021, you see that the numbers in the 4th column, so the 4th column says 7.8 billion for NYCERS at the top, 800 million. Those were what the trajectory based on the model showed, but we didn't adopt them as formal targets. So using the updated data, assumptions, and projections, the investment committee is recommending, the BAM investment committee, that NYCERS set a 2030 target of 8.7 billion and BRRS set theirs at 1 billion. And this is on the way to those same 2035 climate solutions goals that you had set in 2021 that are in the final column there. Question, Keisha? No, okay. So we are proposing that you consider these targets when you vote today at NYCERS and at the next BRRS meeting. Any questions on that? Okay. All right, let me move to the next slide, please. So now we're going to move on to the memo that you haven't convened, recommending that you join 3 climate organizations, which are the Net Zero Asset Owners Alliance, the Institutional Investors Group on Climate Change, and GRESB. I'm going to go over the high-level rationale for each of these recommendations, starting with NZAOA. So this is a membership organization where the controller's office, on behalf of the systems that decide to join, will participate on committees and in membership meetings. We think NZOA will help with collaboration among like-minded asset owners around the world and will be particularly helpful in speaking with a united voice with asset managers. Now, given the right-wing anti-ESG pressure on asset managers that you all know about, have heard about, and that has resulted most recently in 4 of our managers withdrawing from the Climate Action 100 Plus, right? We believe that asset owners speaking collaboratively with one voice will be particularly valuable in this environment. And we think that NZOA is a mechanism and a forum for doing that. So, you know, you see some more details here. The cost is 20,000 euros, which would be split among the systems that join. And let me just address the last bullet here, which is that one thing that NZOA requires is that systems consider adopting a position on midstream and it's actually upstream, midstream, and downstream oil and gas within 12 months. It doesn't require us to adopt any particular position, and we don't actually have to adopt a position. We just have to consider it and provide an explanation. We obviously, NYCERS and BRRS already have a position on upstream, very clear position. We have never considered midstream and downstream. So if we join NZOA, we will do that over the next 12 months and discuss it in the board and decide where to go with it. I mean, just to be clear, we have a lot of exposure to midstream and downstream gas in particular in our portfolios.
John, is that scope 3, the midstream and downstream? Is that
no, it's not necessarily scope 3. It can be scope 1 and 2. What it is, it's midstream is really like transportation of oil and gas, like pipelines or liquefied natural gas terminals, that kind of thing. And then downstream is like processing and retail, that kind of thing. So like refineries are considered downstream, I think. So, okay, let's move on to the next organization, which is the IIGCC. I always get these initials mixed up. So this one is more of a policy group that provides technical support, research, and advocacy resources to members. Our team, our climate team in the Office of ESG has found these resources from IIGCC to be extremely valuable, and we believe the organization will help us implement the goals that you have established in the Net Zero Implementation Plan. It's more international than CERES, which we continue to belong, which is also very high value. And so it should help particularly with the non-US companies in your portfolios with whom we want to engage. We can do that with assistance from the IIGCC. The cost is 12,000 pounds. All three of these have different currencies, and that would also be split pro rata. Okay. All right, if we can move on to the next. So last is GRESB, which is not, it used to be called, that stands for Global Real Estate Sustainability Benchmark, but now it's just GRESB. What's another example? Something that, used to stand for something and now it's just the initials, I don't know. Anyway, this is a sustainability reporting platform for real estate infrastructure. It's widely known in the real asset space, but not all of our managers report on it. So if you approve joining, then BAM would ask your managers to report their data to GRESB, but we wouldn't make that mandatory. So we would ask them to do it. Many of them do, but not all of them do. And then, we'll see how that goes and see if it helps us. You'll recall that we do not have emissions reduction targets in private markets at this point. And that's because the data is very, very sketchy. There just isn't complete data. Our team has spent a lot of time looking at different data reporting platforms, but at this point, nothing is comprehensive enough to say, let's go with this. But we think GRESB is sort of the best option right now for real assets, which have a lot of carbon, buildings and infrastructure. So we'd like to start with that, see how it goes, and then we'll assess how that works for us in terms of being able to report and set benchmarks and emissions reduction goals in that part of your portfolio. So the total cost of the three organizations we're recommending across the three systems is about $52,000. So if all three systems with net zero plans join, NYCERS share would be about $22,600. The BRRRR's pro rata share would be about $2,400. So that's it. Let me see if there's any questions either on the three organizations or on the climate solutions, and that will do it for me. And again, I'd ask NYCERS to take up these recommendations in your caucus today, and BRRRR's when you have your next committee meeting. Great. Thank you so much. It's been a pleasure.
Any questions? No? John, thank you for your presentation. He hasn't been chair in 2 years. You don't need to clap anymore, guys. Really. As John said, we'll take this up when we, in caucus. So we have one other item for public session. And I believe, oh, you're going to do it?
I'm going to start, and then I'm going to hand it in.
Okay. So would you like to do it from the podium, or would you like to?
Can I just do it?
It's not. Okay, so I'm going to turn it over to Allison Hirsch to talk to us about responsible property management standards.
Good morning, everybody. I hope you're all doing well. I am going to introduce the next policy conversation we're going to have with a little bit of background. I'm going to introduce, as many of you remember, we've had a couple of offline conversations about, as trustees about this topic, but about 18 months ago, the Bureau of Asset Management began a process of assessing whether there was any way that we could develop standards around the behavior and management that our single-family rental and multifamily rental asset managers who own single-family and multifamily rentals, can adhere to when they are investing money in real estate and residential real estate on behalf of our systems. And the rationale there is that there, as we all know, there is reputational risk and regulatory risk associated with investing in rental real estate in housing around the country. And we've all been aware of various times where one or another of our asset managers has been in the press for negative tenant practices, et cetera. And so what we set out to do was to see if we could develop standards within our fiduciary construct and responsibility that would limit the reputational and regulatory risk associated with these investments. And so with that in mind, we began a process and worked in partnership with For the Long Term, which is a organization made up of state treasurers and controllers from across the country. And For the Long Term brought on an amazing consultant who you will hear from shortly, and I will introduce shortly. And Monique King-Veland, who will be making the presentation today, has been consulting for a little over a year on this project and really spearheading it. Within the controller's office, our very own Kate Visconti has been the point and project manager of this project. And the real estate team, really led by John Glusak, has been instrumental in getting us to this point. So it's been a real team effort, and I'm really excited to hand it over to Monique to walk us through what we are hoping we can accomplish.
Thank you, Allison. Kate, can you pull up the slides? Awesome, great. Good morning. Thank you, trustees of NYCERS and BERS, for inviting me to be here today, or at least virtually, and for the opportunity to speak. Next slide, please. We are probably facing some of the most challenging housing market dynamics. I've been in the world of affordable housing, homelessness, and housing justice for more than 2 decades, and I have never seen a more complex set of converging circumstances. The high cost of housing and increases in homelessness are consistently ranked as top concerns in research in communities across the country. And an insufficient supply has exacerbated affordable housing and homelessness challenges. Moreover, the rise of institutional scale single-family rentals has elevated concerns about protecting tenants from abusive practices that increases the rates of housing instability and displacement. The need to address those dynamics really shaped the initial thinking behind this work. And the goals of the project are to enhance the long-term sustainability of the residential rental housing market by improving resident stability and well-being, and to increase the social impact of rental housing investments. And in addition to the context that Allison provided and the need to address the dynamics I just mentioned, there's a strong business case driving this work as well. The work focuses on improving long-term investment risk and return, maintaining or producing better housing quality at lower costs, aligning with the emerging regulatory environment, and reducing reputational risk. Next slide, please. A key outcome for this work was developing a set of standards that were both impactful and practical. And to do that, outreach and engagement were critical. Developing consensus among key industry stakeholders on a set of standard tenant protections and supports that could be adopted by diverse industry participants was a key outcome for this work. So we engaged in an extensive stakeholder engagement and outreach process to build the necessary consensus and buy-in, but also to tap into feedback and insights to better position us to build an investment policy that is, again, as much as possible, both practical and impactful. And this graphic just gives you a snapshot of the various stakeholder groups we engaged and continue to engage with in this effort. Next slide, please. A core component of the process was sharing of the initial principles, standard and best practices, and the disclosures with the asset managers for feedback. Again, because that goal is the development of standards that really sort of thread that needle of practicality and impact, it was essential to hold space for the asset managers to provide insights and feedback that helped us to further refine the standards. We hoped this approach would also build collective buy-in that would better position the standards for successful implementation. The initial groups we engaged were developed in consultation with the real estate team with a lens towards ensuring a diversity of perspectives. So, for example, affordable versus blended portfolios, total assets under management, those who were vertically integrated versus not, et cetera. As of today, we met with 8 asset managers shown here in individual introductory feedback sessions, and we hosted working group sessions for additional feedback and further refinement with a group of representatives from the various firms. Next slide, please. These meetings with the asset managers were incredibly fruitful and informative. Following these meetings, we asked for and received additional feedback from these managers in a variety of forms, i.e. written, follow-up meetings, etc. This slide really summarizes some of the key learnings from those sessions. By and large, there's been broad support and enthusiasm for the work and appreciation for the true engagement. I also think it's important to note here as well that we also engage with the Office of General Counsel on fiduciary duty, and that engagement resulted in further adjustments that are also reflected in what you received and are seeing today. We have learned a lot, and we're confident that the insights and the feedback we heard help shape stronger and more impactful standards that are also better positioned for collective buy-in and implementation. Next slide, please. The decision framework for the standards is designed to include specific property management policies and practices. The framework is grounded in research and policy, and as I noted previously, has been developed over the last several months, 18 months plus, in consultation with a variety of different stakeholders, including the groups that I mentioned previously. At the top level, there are overarching principles, and within each principle is a set of practices, standard practices, and in most cases, also best practices. You can think of a standard practice as the common practice or business norm commonly used to produce a desired outcome, whereas a best practice is a method or technique that has been generally accepted and proven to be more optimal or designed to produce even more optimal results. And then weaved into these principles and practices are a set of public disclosures. The disclosures are intended to enable tenants to make more informed choices. And investors may also use them to compare opportunities, but they would be in addition to any disclosures that might be provided in the normal course of the investor's due diligence process. And finally, the standards, principles, practices, and disclosures are the underpinning of the investment policy statement and the IPS details reporting requirements. Next slide, please. So there are 7 principles, and you can see them here. Implement consistent and fair tenant screening and selection practices, offer clear and fair leases, and reduce undue burdens of security deposits, maintain safe, quality, and accessible housing, foster positive tenant-landlord relations, honor tenants' rights to free speech and free association, optimize tenant stability, and minimize evictions and other negative exits. Underneath the principles are 26 standard practices and 22 best practices. And again, the overarching theme across the principles, standard and best practices and disclosures, is the focus on enhancing tenant protections and reducing housing instability. Next slide, please. As noted on the slide, the Bureau of Asset Management is recommending that NYCERS adopt the proposed Responsible Property Management Standards Policy, yes, that's a mouthful, as part of your investment policy statement for real estate. The form and applicability of the Responsible Property Management Standards Policy is modeled after the system's Responsible Contractor Policy that has been in place for many years. And if approved, BAM will implement the Responsible Property Management Standards Policy on behalf of the boards for all prospective private real estate equity funds as soon as practically feasible. Next slide, please. So I've talked a lot, so I'm going to stop here. I want to thank you very much again for your time, for your patience, and for your consideration. With that, I and the BAM team can take any questions. Thank you again.
There any questions now, or we can hand it over to John Glusak maybe to just touch base on these proposals from the business angle, and then Stepstone, I believe, is on as well to talk through these.
John, all yours.
Thanks, John. So it was critical, as Monique mentioned, to talk to a diverse group of managers. The ones that were mentioned in particular, quite honestly, some of them, drive the market. I mean, when you look at Blackstone or Cerberus or KKR, they are large portfolio aggregators in this sector. When you look at somebody like Avaneth and Related, they are singularly devoted to the affordable housing market. When you look at Waterton, which you're invested in as well, they are a market rate provider of investment housing. And when you look at somebody like Mesero, which kind of funny, you'll hear from them later, also are do market rate and affordable or really attainable / workforce housing. So that was the key. And, quite honestly, I was a little bit surprised about, how eager they are to do something like this. And it really was kind of eye-opening that they worked with us collaboratively. So there were some ideas that they gave to us that were actually better than market standards and better than our best practices, which is great because it shows that they listen and it shows that they're taking this seriously. So I think, overall, in many cases, this will apply very well. You may have some cases, particularly in the non-core sector, where they're converting very rundown properties that it may not work, but post renovation it will, and that's what we talked to them about, and that's what they were open-minded and pleased to do. So Monique's been great, Allison's been great, Kate's been great. Shout out to Sonia Cohen and my group who spearheaded a lot of the aggregation of the data on this, and we support it as a policy that will still let you invest in multifamily, which is very important, and continue to get the great returns from these managers that you've experienced in the past and in the future, hopefully. So I think I'll just pass it over to Justin for a couple words on how Stepstone thought about this and overall the implementation and the effect that it might have on our portfolios.
Yeah, appreciate that, John. Yeah, so just couple quick comments. Just overall, just wanted to kind of be here to express our support for the standards. Overall, I think it should raise the bar for rental housing managers in general. In addition, I think it has an added benefit as well of just kind of providing them some insight into where they can kind of better their practices and where their practices might be able to also improve. And then lastly, the big thing for us as well is whether or not it would hinder the investment opportunity. But, given the fact it's been shaped by several institutional constituents, including BAM, Stepstone, the external consultants and various residential managers, think that the structuring as well should not hinder the investment opportunity. So overall supportive, but I'll leave it with that and turn it over, see if there's any other questions.
I did have a quick question. I'm just curious, relative to, I guess, other systems, would we be a leader in doing this, or are there other systems that have already implemented similar practices?
We would be the first pension system in the country that is doing this. Our hope is that all of the New York City systems sign on board. To date, we have had the initial conversation at teachers, but not taken a vote to date at that system. And then we are bring it here for NYCERS and BERS, and then we'll be having this conversation at the other at fire and police at their meetings in the coming weeks. And then the hope is that other systems across the country will also adopt this, similar to the process that many of you might remember that happened around the RCP, the responsible contractor policy, where John Adler likes to say that that took about 25 years, and our hope is that we will take much less to make this the market standard. But I think Monique, the work that she's going to hopefully continue doing is to, once we become the market leader, sort of encourage other pension funds to join us. And to that end, actually, she and John Glusak are giving a presentation tomorrow at PREA, which is the Pension Real Estate Association, thank you. And they're giving a initial presentation on the standards there.
And we have approximately 50 GPs signed up for that breakfast meeting tomorrow. So, definitely getting momentum and getting interest in the marketplace.
To hold the button down.
I almost forgot how to use this thing. Karina, thank you so much. I thought your presentation was so awesome. It was clear. Monique is the lower. I'm sorry. Monique, thank you. Thank you. And then I'll just reverse engineer whatever I just said. Being a trustee on BERS, housing insecurity is one of the things that we don't talk enough about in regards to, some of the lowest income earners and the wellness around that piece, and being pushed out of New York City for the jobs that we really don't, we take for granted. And so I say that, to be at the beginning of this conversation, when we're literally talking about the needs of the employees and where we need to be focusing on, where minority managers come in, who is more in the community, has more ties within the community that can negotiate some of these issues around housing. Because if you have people being pushed out, let's say for instance, and we're not even, I say there's a few things. There's something about being low on a radar, and then there's something called just not being on a radar at all. And I think that, and that's powerful, because we need to start seeing the people who we depend on every single day, particularly with BERS, and start talking about that housing issue. How are you getting to work to do the job that we are depending on you to do? So I really appreciate this conversation, and I really hope you use the people who are in the community to help facilitate this conversation further, because it is urgent.
And if I can just chime in one more time and just say, I agree. I'm excited. First of all, the presentation was fantastic, and I mean, this sounds fantastic as well. And I have no hesitation about being a leader. So this is great. Yeah, right. No, this is great.
Okay, if there are no other questions, it is 11:50, and I believe that marks the end of our public agenda. And so I'm going to suggest that that we'll go into exec and then maybe take a 5-minute break. So can I get a motion to enter executive session, please? Okay, Keisha, can I get a second? Maisha. Oh, Maisha. Okay, and with that, can I get a vote? Oh, I'm sorry, it's a NYCERS meeting. Sorry, can I get a second from a NYCERS trustee to enter executive session, please?
Second.
Thank you, Larry. All those in favor of entering executive session, please say aye. Aye.
Aye.
Any opposed? Any abstentions? Okay, we will enter executive session. Thank you so much. And please stop the recording.
Turned on. Great, thank you. So we are now in public session. I'm going to turn it over to Elizabeth Reyes to give us the report out.
The board took action on an investment-related policy, an annual investment plan, and investment-related memberships. The board also took action on 2 real estate and 1 private equity investment, the details of which will be released at a later date.
Thank you. And with that, I will make a motion to adjourn. Thank you, Robin. We stand adjourned.
Great. Thank you very much.